Well, hello and welcome. Thank you all for joining us today for this credit union exclusive action planning for liquidity management. My name is Omar Jordan. I'm the founder and CEO of Coviance. And for the past year, we've been on a mission to help our customers, credit unions, community banks navigate through liquidity challenges. And before I introduce you to our guests on the call, I'll share with you what led me to ask Frank and Jeff to join me. They have decades of experience specifically on this topic and more. And as an industry, we've gone through having too much liquidity in 1 year on the balance sheet to now not enough. And one day I was doing some research and ran across a webinar that Frank and Jeff did. I thought it was extremely informative, and I thought it was a perfect substance and content in there. And I felt every bank and credit union executive should absolutely listen and learn from both Frank and Jeff. And so I'm thrilled to welcome our guest, Frank Farone, Managing Director at the Darling Consulting Group. Frank consults nationwide with CEOs and CFOs, financial institutions of all sizes, on a host of issues facing credit unions today, from capital, liquidity, funding, interest rates. And he's a speaker and an author. I encourage you to reach out to Frank and continue to learn from him. And then last but not least, Jeff Croteau is a senior consultant at the Darling Consulting Group. Jeff works with financial institutions, executives, in strengthening their assets, liability management process, consults on managing interest rates, risk, liquidity, and capital risk. So Frank, Jeff, welcome. Thank you. Let's take it away and give our audience a taste of what we have planned today.
Great. Thank you, Omar, and welcome everybody. Our hope today is to kind of enlighten you with some of the things that we see going on in the industry, particularly on the liquidity side, and share with you our approach to measurement of liquidity and management of liquidity and all the things that go into a robust liquidity management process. And given all the challenges that we're facing today in terms of tighter liquidity, lower levels of income, shrinking margins, an inverted yield curve, we're going to talk about why liquidity is so important when it comes to managing through a lot of these challenges and issues. So you'll notice that the slide at the top says this time it's different. And it is different because liquidity has been evolving for decades. It's a lot easier now to move money. There's a lot more alternatives than there used to be. And so whenever we get into a situation like this, we need to make sure that when we're looking at our liquidity position and trying to manage our liquidity position, we look at some of the hidden risks that are in our balance sheet that maybe we hadn't thought about before. So we're going to talk about some of those things as well. So think about what Omar said. You know, we came from a situation where we had more liquidity than we knew what to do with. It was putting pressure on our capital ratios. All of our asset yields were screaming down. We're getting crushed. And our margins were just coming down, 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 down. And then what happened? We got a little bit of slope in the curve at one point. And a lot of institutions, I'd say probably most institutions, saw the opportunity to get out of cash and go a little bit longer on the curve to pick up another 200 basis points in spread. And we all know what happened since then. The Fed raised rates at the fastest pace in most of our lifetimes. The rate of change, the magnitude was probably the fastest and widest in modern banking history. So now we've got an inverted curve. We've got deposits that are shifting out of non-maturity deposits into other alternatives outside the credit union, or they're going into CDs. And we're stuck with, for now anyway, a lot of low yielding assets. So funding costs are rising at a much faster clip than our ability to generate higher yields on the asset side. And therein lies the squeeze. Meanwhile, with the bank failures that have occurred, right, the regulators have liquidity under the microscope, and they're asking the tough questions. And so hopefully after today's webinar, you will all be much more comfortable with the amount of liquidity that you have, how to measure it, how to manage it, and all the things that you need to do to make sure that if something goes wrong, right, you've got a contingency plan in place. And that's where my colleague Jeff will walk you through. So let's go to the next slide. And as I mentioned earlier, liquidity is shifting. And if you think about it logically, right, you could go all the way back to the Flintstone age. And what you would see is you would see a very similar pattern of rate movements, shifts in deposits as interest rates change. And I'll show you in a minute. But in the meantime, loan to share ratios, right? On average, if you look at a 10-year average, it was about 77%. And then we know when COVID hit, it came screaming down, right? Because of all those deposits. Now it's moving up. And as it's been moving up, this is a metric that regulators look at. I'm going to share with you how a loan to deposit or loan to share ratio doesn't tell you anything about your true liquidity position. And in the credit union world, there just tends to be a lot of ratios. Regulators love ratios and metrics, and that's one that is going to be very important for us to understand why a loan to share ratio doesn't necessarily tell me anything about my liquidity. Meanwhile, with loan growth moving up and share growth moving down, and by the way, think about inflation. You know, with inflation going up as fast as it is, you know, a $100,000 loan you made a few years ago is now a $125,000 loan because of inflation. And meanwhile, pay raises aren't going up 25%, so deposit growth is lagging, you know, the asset growth. So borrowings to shares, we're going to talk a little bit about that too. They're on the rise. They're always on the rise after you get a Fed tightening cycle. And think about when you get a Fed tightening cycle, when the economy is very strong and robust. And so that goes in cycles too. And one of the things we're going to talk about is, you know, what is a reasonable borrowing to asset ratio? Is it 10%? Is it 5%? Some of you may not even like to borrow. That is a bad word within the credit union.
It seems to be. And Frank, I had Rodney Hood, and you and I talked about this yesterday too. I had Rodney Hood, the chairman of the board, or 11th chairman of the board at the NCUA, on a call previously a couple of weeks ago, and even the NCUA does not look at you know, loan to share ratio as a way to measure liquidity. I mean, but it seems to be on everybody's you know, first thing that comes out when we talk about liquidity is loan to share ratio, and I feel like there's a misconception as to what that is. So I'm glad you're pointing that out.
Yeah, and you know, Omar, Rodney understands it. Rodney gets it, but Rodney isn't the guy that walks through the door for most of the credit unions on this call. It's somebody else that has the old training manual, and so your rating is going to be based upon, right, who walks through the door. And that's why at the end of the day, right, it's incumbent upon us to make sure that we can explain and articulate our position. I have credit union clients that had loan to share ratios as high as 140%, right? And they didn't get the best rating. They didn't get a 1, but they didn't get a 3. They got a 2. And it's all because of their approach, their policies, and all the things that we're going to walk you through today. And you're not going to be an expert after today, but we're here as a resource if you want to tap into it. So this is something that we're going to take a closer look at. If we look at the next slide, you'll see that this is another one. Cash and short-term investments to assets. So think about it. If you have a lot of cash and a lot of short-term investments, you have higher levels of liquidity versus a credit union that doesn't have a lot of cash and short-term investments. That's really looking at things from a cash flow perspective. We all know about the old movie, It's a Wonderful Life. Mm-hmm. What happened? People came, they wanted their money. You couldn't tell them you've got an 11-month CD coming due. They want their money now. They want it today. So we're going to talk about this ratio. And this is one I can tell you, it's not just the credit unions, it's the banks. They're looking at this number, and there is no requirement. There's no minimum, unless some of your state chartered credit unions have to have a 5% minimum. But we're going to talk about this ratio too. And hopefully, again, once we go through this, you'll look at liquidity a little bit differently. So that kind of sets the stage. And one of the things that I mentioned earlier is just there's an ebb and flow of deposits. There's a change in mix, and it's very predictable if you look at rates over time. And so one of the things I think is one of the risks that we think is lurking in a lot of balance sheets today is the assumptions that go into the model for a number of things, but particularly in terms of non-maturity deposits. So if you look at the graph on the right, this is from a year ago, right? This is September of 2022. When you look at this graph and you look at those bar graphs, what that shows is with a static balance sheet, no growth, our income just slowly but surely continues to migrate higher and higher and higher over the next 5 years. I can tell you, when I look at that, I know something is wrong. And if you look at the underlying assumptions in the model, it assumes there's no change in deposit mix. And we know you're starting to see, because of the rapid rise in rates, slowly but surely, non-maturity deposits are migrating out. And so we built in a 25% migration out of non-maturity deposits into, we picked a 1-year advance, assuming if the money leaves or we have to replace it with a 1-year CD, it doesn't matter. The rate is the same. But look at the difference between the credit union on the left and the credit union on the right. And that begs the question, which one do you think is more reasonable, rational? And we talked about this before the call. There are a lot of credit unions and there are a lot of banks right now. When we're helping them with their budgets and we're looking at next year, a lot of them, it's flat. When I say flat, there's no income to potential losses. And we get calls every single day. Documented resolutions from the NCUA. We get calls every single day. I got one this morning, 124-page documented resolution for a very large credit union. It's always done very well, very successful. All of a sudden now they're getting written up for just about everything. And so it's important to understand what's in the model, test your assumptions, and then if you look like this credit union on the left versus the one on the right and your income is going down, the next question is, if that's the case, what are we going to do? And that's where you have an effective ALCO process. If you look at just the trend in deposits, think about it. This is common sense. Let's just start with where COVID hit, right? And if you look at March, April of 2020, and you'll see that orange line, right? That's non-maturity deposit growth. And so non-maturity deposits, we all know, jump. If you look below, you look at the next month, below the line, those are CDs. What was happening? CDs weren't growing, they were actually migrating, right? So we were losing CDs. There was a shift out of CDs into non-maturity deposits. How come? Rates were so low. That continued until all of a sudden rates started to move up. And we lagged as long as we could. And then there is a point at which rates move up a certain amount, and then you start to see migration. And it's consistent, cycle after cycle after cycle after cycle. And then deposits are not linear. You don't move your deposits up 20% of the rate movement. You go very little, very little, very little, and then you have to play catch up. So here's what's happening. And it's a function of where we are in the rate cycle. CDs are now becoming a much bigger part of your balances, and non-maturity deposits are migrating out. So the question becomes, where are we relative to where we would normally expect that mix to be? If you look at where we are now, all the way to the right, non-maturity deposits relative to CDs, there's still a huge gap. Look where we were, go back to 2006, 2007, 2008. Rates were about pretty similar to where we are now. It was about a 50-50 mix. I don't know we're necessarily going to get to 50-50, but we're a long way away, we think, from non-maturity deposits maintaining a stable balance. So if we go to the next slide, right, this is just looking at, once again, non-maturity deposit balances, and you can see they kind of peaked somewhere in the middle of 22, and now they're starting to come down. Our forecast, and this is from our data scientist group, right, is non-maturity deposits are probably going to continue to decline, whether rates go up, down, Fed cuts, or they stay the same. And you can see where the lines are, and it's anywhere between 10 and 13%. We would just encourage you to make sure that you've got some level of shift in your balance sheet today And so that you don't wake up 3 to 6 months from now wondering what happened to our income because we had that shift in mix.
Frank, do you project we'll still continue to see deposit migration happen through 2024?
We do. And so, again, that's if you go back a slide, Jeff,
Yep.
this is going all the way out through. We did this in what, June?
Yep.
All the way out to next year, anywhere between 10 and 13%.
Wow.
And again, that's just looking at what our data scientist group has forecasted.
Yep.
And they've been actually pretty spot on. They've been following us in our webinars. And so, yeah, even if the Fed cuts rates, we're still going to see non-maturity deposit migration out. And we're going to continue to see higher cost of non-maturity deposits, even if the Fed is done. And so lower level of balances and higher cost. If you go to the next.
So if you're a credit union, what are some of the things that you can do to help keep some of these deposits on the balance sheet?
I'm gonna defer to Jeff for that because Jeff is a liquidity expert. But and by the way, we could spend, and we have several webinars on that, spend all day talking about that and different strategies. But at the end of the day, I can assure you a lot of the things that you would do are going to be very expensive. And that's where it comes back to, at some point, we're probably going to be relying more, or should be relying on more, or should be using more of the wholesale markets. Because I can pick up the phone, I can tap into the brokered CD market, I could tap into the Federal Home Loan Bank, I can get money in the 4% range in the home loan bank system right now, exactly what I want for the term that I want, as opposed to going out and paying up and then cannibalizing my existing deposit base. And that's why coming back to liquidity measurement and management and how we approach it is going to be critical for the group, so that you can use the wholesale markets to your advantage without getting hamstrung with your existing policies. So here's just an example of taking 10% migration, right? And I did this, for a client a few months ago, and that is looking at if 10% migration occurs, materializes, right? That's going to cost us a pretty good chunk of change. And you can see the difference at the bottom of the page. That's probably a reasonable, rational approach. And if that's the case, what are we going to do to make up that lost income? That's when we start talking about strategies, deposit pricing strategies, growth strategies, using the wholesale markets, growing the loans, right? I hear this all the time. Well, we'd love to grow our loans, but we're pricing them up because we don't have the liquidity. You've got plenty of liquidity. Don't let these opportunities get away from you. So we'll talk more about that after we go through the approach to liquidity measurement and management. So let's go to the next slide and talk about measuring and managing liquidity. So let's just focus on the top of the page. This is our definition of liquidity. It's the ability to raise money quickly without losing money at a reasonable cost. So what that means is, what's the ability to raise money quickly? That's like now. Pick up the phone, access money. We either have it at the Fed or you have it in the form of cash. Having cash flow that comes in over the next 12 months is not, in our opinion, liquidity, right? We want it, we need it now. And we're going to show you in a minute the approach that we take without losing money. If we have securities on the books, or we have loans on the books that are at a loss, we don't have to sell them. We can pledge them and we can borrow against them. What's a reasonable cost? It doesn't mean going out and posting a 6% CD on a bulletin board, or offering a CD special at a high rate. No, we're talking about market rates. So if you believe that that's a reasonable, rational approach, and we're going to walk you through how we measure this, you'll notice at the bottom of the page, I've got unrealized losses. I hear this every day. I get calls every single day. Frank, what do you think of this idea? Our broker is telling us we should sell securities and we can buy higher coupon. It's going to help our NIM, our ROA. Blah, blah. No, show me one idea where that makes sense. And I would challenge any of you to send it along. And I'll walk through any strategy somebody's showing you. I've yet to find one, in my opinion, that makes sense. And I see it every single day. And there's always something missing. So let's go to the next slide. And, speaking of unrealized losses, the most important thing on this page is Everybody's got unrealized losses. Very few do. Very few don't have unrealized losses. The question becomes, is there any reason why we would need to sell any type of security to raise liquidity when we can pledge them? Number one. Number two, they're all going to come back to par over time, right? So there's no reason to take a loss right now. The other thing is, what's the break even on selling something to go into current market rates? What's the break even on that? And I can assure you, it's a losing proposition. Again, we offer out our advice if anybody wants help on this. But this is going to feed right into the approach that we're going to show you right now. Okay, a total liquidity solution. There's a lot of number on these pages. The most important thing to understand is we're looking at, on the left, what would be considered to be a strong on-balance sheet liquidity credit union. The one on the right looks like it's got tight on-balance sheet liquidity and overall liquidity. So this is the old cash and securities, right? So the one on the left, it doesn't have a lot. I mean, it's got $91 million, right, in cash. It's got securities that they can pledge, right, by picking up the phone, right? And you add all that up and you come up with this liquid asset ratio. They've got about 25%. Pretty darn good, right? The credit union on the right, they don't keep a lot of on-balance sheet liquidity in the form of cash. So when you look at their cash and unencumbered securities, it's only 5.6% of liquidity. Now, some of you might be getting criticized because it's below 10%. They love 10%. They like 15%. But at 5.6%, you might get criticized. This doesn't tell me anything about my liquidity. Why? Because beyond just looking at securities and cash, we can pledge loans to the Federal Home Loan Bank. So if you go to the next slide, there's really, three parts to this. On-balance sheet liquidity, cash and unencumbered securities, the ability to pledge money, pledge securities at the Home Loan Bank to access funding. And it doesn't matter if it's a home equity loan, a commercial loan, a 30-year mortgage, or an armed security. It doesn't matter. The Federal Home Loan Bank allows you to pledge loans that you can borrow against. And so this particular institution, right, this credit union has a policy of up to 25%. So you add up their on-balance sheet liquidity plus their ability to access the Home Loan Bank, that gets them to 22%. They have a policy of 10% of non-member CDs or brokered CDs. And when you add it all up, they've got 32%. And we actually build in a little buffer for runoff of 8%. So from a regulatory perspective, they really have about 40% liquidity. So that's a lot of liquidity. Now, look at the credit union on the right, right? When we look at their access to the Home Loan Bank, you'll notice they've got 45% as a policy guideline. By the way, what is the regulatory limit for borrowing? It's 50%. Some of you may not even know that, but it's 50%. And yet some of us have a policy of 5% or 10%. Give yourself the maximum flexibility. So the credit union on the right, that tight liquidity, because they didn't have a lot of cash, they have access to the Home Loan Bank. They carry a lot of their liquidity in the form of assets, in the form of loans that they pledge. So which one of these two do you think is going to be a more profitable credit union? I'll give you a guess. Look at the tier 3 now. Simply CD, up to 20%. So when you look at the two and you add it all up at the bottom of the day from a total liquidity, they're the same. They're the same. And think about it. The definition of liquidity, the ability to access money quickly at a reasonable cost. This is all market rate, Home Loan Bank and Simply CD, without losing money. We don't have to sell anything. We pledge it and we can access funding.
Such a powerful slide. This is one of my favorite slides in this presentation for me. And we hear a lot of credit unions talk about they're tightening their home equity lending for the year, for example, because of liquidity. And I heard you talk about this in the past, where this is a perfect opportunity for a credit union to actually maximize their home equity lending market. It increases their TAM, it increases their share of wallet with their customer. That's one. Two, it keeps deposit migrations because it's the #1 requested consumer loan product right now for debt consolidation, home improvements. These are the two. And so making sure we are continuing to lend and pledging those assets so that we can generate liquidity. Is that what I'm hearing here?
Yep. No, that's exactly it. And we go through this every cycle, and there's a tendency when credit unions and banks too, they don't have a lot of excess cash and a lot of excess liquidity, and the yield curve is flat or the yield curve is inverted. They tend to do the opposite of what they really ought to be doing. And think about it. When money is plentiful and you have plenty of cash, when does that typically happen? When we go into a recession, rates fall. And then we put the money to work in a low rate environment. And then when rates go higher and the curve inverts, it doesn't look like there's a lot of spread. I'm borrowing at 5.5 and I'm getting 6.5% spread. We're not buying spread. We're buying income and we're buying protection against the inevitable, which is falling rates and a recession. And so if you can tap into, particularly now, people aren't going to be moving for a long time, and they have a lot of equity. Home equity loan product would be a great asset to be booking.
Absolutely.
So let's go to the next slide. And this is what I just showed you on one page. This is the approach. And one of the things that you'll notice is on the right side of the page, right, which I didn't show you on the earlier, is access to the Federal Reserve. Now, typically, we think about the Federal Reserve as being the lender of last resort. So we don't count that as part of our operating liquidity like we do on the left. But in today's world, today's market, given all the things that happen, this particular institution, right, they took down 60 million because it was very, very favorable funding, right? So, and you'll see a lot of notes on the bottom of the page, but on one page, based upon our definition of liquidity, every one of you should be taking this approach and looking at this, and we'll help you if you have any questions on this. So that's our liquidity. And so now one of the things that we all know the regulators are asking is, and think about SVB, how many deposits do you have on your balance sheet that are uninsured? I would say that the majority of credit unions have 95% or more of their deposits that are insured. You have very little in this way, but make sure you know what that number is. And that's all I'm going to say on that slide. So we just took an inventory of our money, meaning we know what our liquidity position is. We know how much access to liquidity we have. So now the question becomes, over the next 90 days, what's going to change? What do we have in the form of net new loans that's going to require funding and net new deposit flows? And what we're finding now is loan growth is outstripping deposit growth. And so rather than go out and raise CD specials or turn down the loans or sell the loans, if your capital allows you to support that growth and you can't get it through the retail window, then utilize the wholesale markets. And the funding that you might decide to take down, whether it's short-term, 1 year, 2 year, right? That's all a function of your interest rate risk. So a 90-day forecast operationalizes our liquidity position. And if you're comfortable with the approach that we just showed you and your loan demand outstrips your deposit growth, then fall back to, again, the basic surplus, which is all the way to the right there, how much liquidity you have to be able to support that. Okay, let's go to the next slide. And one of the things that, for some, it's kind of a bad word, is derivatives. But one of the things that you are all very familiar with is the whole NEV test and the NEV supervisory test. And I've got I have smaller credit unions, $200 million that use derivatives. I have 40, $50 billion credit unions that I can't get them to use derivatives. And now, all of a sudden now they're saying, Frank, we need you to come back in and get the board educated on derivatives. We missed it. And now we've got all these regulatory issues because we've got all this interest rate risk, value at risk, et cetera. We need to get up to speed on derivatives. So I would encourage all of you to explore derivatives. I'll give you a couple of examples, and I'm going to let Jeff jump into his thing as to how we can use this. So this was a client that I worked with back in 2022. And they had a lot of loan growth over the first 6 months, and we funded it all out of cash. And life looks pretty good. We go to the next slide. And again, remember, this was back in 2021. Our data scientists said you're probably going to lose 50% of that surge deposit, right? Before all is said and done. So you build that into the model, and all of a sudden, it doesn't look so good. All that growth isn't even sufficient to offset all that loan growth. Sound familiar? It's kind of like having tomorrow's newspaper today. So now what do we do? Right? Let's go to the next slide. One of the things that we did was we said, well, you can support all that growth. However, you're going to have to hedge your exposure to rising rates. Nobody needed to borrow money from the Home Loan Bank, 3-year, 4-year, 5-year money. So you fund it, and then we put on 3, 4, and 5-year interest rate swaps to hedge against rising interest rates. And now when you look at the bottom of the page, you look at the loan growth with the interest rate swaps. And by the way, this is simple stuff. It's not as complicated as everybody thinks it is, right? Now look at the difference. Okay, let's go to the next slide. We combine everything, and net, this is what we think was a more reasonable, rational risk profile. And again, it all comes down to the assumptions that go into the model. And I could show you a lot of strategies. One of the things to think about right now, if you're really feeling pressure, is because the curve is inverted, you can put on 2-year swaps, pay fixed, receive floating, and pick up 60 basis points in your pocket. Okay, that's all I'm going to say about interest rate swaps. And the next slide has all the things that we can learn about liquidity from what just happened. And I'm not going to walk through these, but you can walk through these on your own. But I kind of set the stage for how you measure liquidity, how you manage liquidity, and then Jeff will now take you through the things that you need to be also aware of in terms of contingency plans and all the stress testing that you're going to have to run. And by the way, this isn't just for the regulators. This is for you to help you manage your credit union more effectively. So Jeff, it's all yours.
Thanks, Frank. And before I get into the stress testing, contingency funding plans, I am going to touch very briefly on the deposits. Although with that said, I'm not going to give it the justice it deserves in today's environment, just in the interest of time. I would encourage you to check out our website, though. We do have several webinars that are dedicated to deposit strategies, and Frank and I are always here to help. But without further ado, here's a few areas that we're talking with our clients frequently about when it comes to deposit analytics. First is retention. And Frank shared the stats with you. It's going to be tough in today's environment. We know deposits are leaving the industry. We know there's a shift from lower cost non-maturities into higher cost CDs. But can we identify pockets of potential risk or opportunities within our data? So one example would be we have a lot of credit unions with middle market, legacy saving and money market accounts, let's say $50,000 to $200,000, that are starting to see a lot of attrition. Can we get in front of some of our members that look and feel like this before we start to see those outflows, if we have a marketable product today? On the money market side, reviewing your tiers is something I would encourage everyone to do. We find a lot of credit unions, maybe 250,000, but even 100,000 is the highest money market balance tier. We often find 70, 80, even 90% of the funds might reside in that highest tier, which doesn't give you a lot of pricing flexibility as rates change. So we encourage folks to do that before this rising rate cycle, but certainly on the way down too. I would encourage you to take a look at your tier distribution. On the CD side, I bet most of us on the line came out with our first wave of CD specials back in the summer or fall of 2022. We probably have big pockets of maturities coming due over the next 3, 6, 9 months. Mm-hmm. Do we have a game plan for those? Do we want to differentiate between who is the hot money versus who is the long-term members? Depending on our liquidity position today, we might take a different strategy. And then just this theme of staying active, a lot of groups are starting to invest in deposit analytics today and starting to look under the hood more, especially because it's expected by the regulators. But those that are really succeeding or benefiting from this are making it part of the culture and DNA of the credit union. Here's just a couple of quick analytics from our deposit system. So here's what we're seeing from a CD trend analysis standpoint in 2023. Strong growth overall, about 40% portfolio growth, but almost half of it was cannibalized from the non-maturity deposit portfolio. And the average cost increase there was just shy of 400 basis points. So I know we're all aware of this, but we just need to be cognizant of the fact that when we're out there with our 5.5% CD specials, the cost at the margin is certainly going to be higher, and we need to be analyzing what are we seeing for cannibalization on our own balance sheet. Here's an example of an early warning system that a lot of our clients are using from a retention standpoint. One of many early warning indicators, but what this is tracking is consecutive months of balance decline. Our data science team has found accounts or relationships, once they start declining for 4, 5, 6 consecutive periods, the likelihood of a closure in the next year is higher than an average account. So can we flag this information, track it on a macro level? Are we starting to see these dollars increase in this 4, 5, 6 month window bucket? Or we could even get tactical. We have credit unions that are pulling up a list of those largest members and physically making phone calls to those, where there might be a concerning trend, or if they're looking to win back some of that liquidity. This is another example I mentioned earlier. Let's start to do some deeper segmentation analysis. Here's some legacy savings and money market accounts that are 50 to 250,000 that are getting paid a low interest rate. We can segment that further. Who are some of my deeper customers that have multiple products with me versus those that are single sourced? And who are those that are new since the pandemic that have been with me since multiple cycles? We also have a lot of, accounts where they might have come on as a premium money market at, let's say, 2% back in 2018. Fed funds was half of what it is today at that point in time. And if they're only getting 50, 75 basis points today, when there's options out there at 4, 5+%, these are people that are ripe to go. So if we're looking for customers that are at risk, do we have the data in place to do the appropriate segmentation analysis? So again, that really doesn't quite do it justice on the deposit side, but that's all we have time for today. Again, we're happy to answer any questions you may have. I'm now going to segue into NCUA feedback and common reoccurring themes that we hear when it comes to contingency funding plans, key risk indicators, and stress testing. I'm going to start with a liquidity risk monitor. And just to level set, what I mean by that is we want you to identify a list of key risk indicators that are going to be an early warning system to a liquidity threat so you can react well in advance. So here's 5 must-haves, again, based off of NCUA feedback. We often find credit unions just have one guideline limit. So they might have, cash plus short-term investments is 5% of total assets. But the NCUA wants to see a guideline or an early warning system. Why don't you have risk triggers at 10% and 7.5%? That way, as liquidity tightens, it's going to set off some bells and whistles, prompt management to have a discussion. They don't want you to get notified after the fact of breaching a policy limit. In the same vein, just because you trip one of these early warning systems, that doesn't mean we have to enact a contingency funding plan. It just means we need to have a conversation about the severity. So we need to have different qualitative responses based off of what types of triggers we're tripping or the severity of that. And we need to have different levels of action plan. Our contingency funding plan needs to lay that out. I'll spend a little more time on that momentarily. The NCUA, we've seen constant findings of you don't have enough indicators. All you track is loans to shares, cash and short-term investments, and a couple of wholesale funding metrics. What about potential credit quality issues? What about potential funding concentrations? That's especially a big one today because of the bank failures. Frank mentioned it, but any uninsured deposits, if you have, large pockets of reciprocal deposits or any wholesale, again, we got to be tracking those items. Leading indicators that can be difficult when we're talking about historical ratios, but one example, can we look at 30-day past due loans or any troubled loans versus non-accrual or charged off? And we even have some of the bigger credit unions that are looking at forecasted metrics on their key risk indicator set, also to incorporate some back testing component. Lastly, these need to be under constant review. There was interagency guidance that came out, and it was about stress testing, contingency funding plans, reflecting today's business risks and ensuring that they're up to date. So if your assumptions in your stress test or your KRIs are feeling at all stale, you definitely want to update that heading into your next exam. Here's an example of a risk monitor. This group has about 20 key risk indicators. Depending on the size and complexity of the institution, that could vary from 10 to 30. Some of these are going to be common for pretty much every group. Some will be unique based off your balance sheet. So again, that's something you're going to have to comb through on a periodic basis. Here's those 3 risk levels I mentioned. So if you have a true policy or guideline, it goes in risk level 3. Here's our early warning system to notify us if we're creeping up on policy. And again, if we want to run a little bit tighter on liquidity or have more flexible policies, a type of early warning system like this is going to give you the flexibility, give your management team and examiners the comfort to operate in that manner. On the right-hand side, this is, the most important part. Again, just because we're tripping a few of these risk levels does not mean we necessarily have to enact the CFP. All the way to the right, this stress level, that's that qualitative response. We're going to have multiple of these types of responses, some of which are going to deem we need immediate action or there's a crisis at hand, and the CFP is going to have to document in great detail what we would do during that time. So I'm going to segue to the CFP here. And again, here's 5 things that we very commonly hear from the NCUA. One is documenting roles and responsibilities. So who at the credit union is actually part of this liquidity crisis force and who is responsible for what as that crisis evolves. Number 2, that's kind of what I just mentioned on that risk monitor. And I think this is one of the most important parts of the CFP. And our contingency funding plan is pretty robust. You'll see on this table of contents here, it's 23 pages. And about half of that is dedicated to this second bullet point here. So again, on that risk monitor, on our stress tests, as we start to breach uncomfortable levels and we decide we are going to actually take action, what are the physical actions we would take once we reach these different uncomfortable scenarios? So again, that's going to be different for every institution. Everything should be on the table, but it's healthy to go through that dialogue every so often. Number 3, you want to have some mention of how you came up with your key risk indicators and stress tests. But if you put too much information in there, you might feel confined to run exactly, what you have in your CFP. And we even had groups that were reluctant to make changes to their stress testing process that they knew was for the better, based off of the bank failures, but they were reluctant based off their policy. So we don't want that to happen. Skipping ahead to number 5, because the constant review goes without saying, this is extremely important in today's environment, really because of the bank failures. SVB, time was of the essence. We've never really seen that in the industry where they lost a meaningful amount of deposits in an afternoon. So in a contingent window, we've always thought 30 days or less, and that's still generally appropriate, but we need to demonstrate that we have intra-week and intra-day plans for getting our hands on liquidity in a time of need, since that kind of reared its ugly head back in March. So I would list all of my emergency contacts and I would document what is the playbook to get my hands on all my funding sources. And do I have the collateral in place? And if I don't, how long would it take to post or move collateral? Are there any risks associated with obtaining these funding sources? I would document all of that in a playbook style, and I think that'll go a long way with the examiners. I would also test all my lines. You should be doing that periodically, especially though in times of stress, to see, who's still there for you on a rainy day. From a secured line standpoint, you're probably okay, but any unsecured lines with, other credit unions, I would be willing to bet that, some of those have been revoked or would not lend. I know we only have a couple of minutes left before we start to open it up for questions, so I'm going to quickly go over forecasting and stress testing. Frank already touched upon this, so I'm not going to spend too much time here, but when we're thinking about stress testing, near-term liquidity planning is very important. So what's happening over the next 30, 60, 90 days, and let's war game from there. What if prepayments slowed down, for example, and originations continued? Do we have the liquidity on hand to fund that? Do we have the dry powder on balance sheet? And if not, are we going to come out with a deposit special? Are we going to utilize the wholesale markets? Let's not be caught off guard. Let's go through those conversations. I would be pulling levers on the deposit as well as the loan side, again, so we're less reactionary, as these things come about. So that segues into stress testing. I am not going to go through all of these in the essence of time, but use this as a checklist. And again, Frank and myself are happy to answer any questions you may have or, walk through your process with you. But we don't want to just be sensitivity testing off a point in time. This needs to be a dynamic model where it's a going concern. We're looking out a year, 2 years, monthly cash flows, prepayment assumptions built in, and business activity layered on top of it. We should be doing that anyway, but especially when in the base case environment, there's pressure on liquidity. If we're losing deposits or loans are outpacing loans are outpacing share growth. If that's not built into our base, that's already going to cause, a line of questioning with the examiners. Assumption defense, they want decay studies done. They want credit stress testing, for credit quality, quantitative support. If you don't have institution-specific support, I would at least do your homework on, industry norms and take a look in the rearview mirror for institution worst experiences. Macro and idiosyncratic, I think most groups do a good job with macro, but I would challenge you, look at your own balance sheet. If I were an examiner, where would I try and poke a hole? I would run a scenario addressing that. An easy one from a concentration standpoint is unfunded commitments or unused lines of credit. The NCUA loves that from a stress testing component. If you're not already, I'd add it to your list of key risk indicators and incorporate that into your stress test. What if I had to fund 50% or 100% overnight? Same thing with funding concentrations. I think everybody should be looking at surge deposit runoff or uninsured runoff, given what happened in the banking industry. On the right-hand side, this kind of goes without saying in the theme of that interagency guidance this summer. If our stress tests are stale, if our assumptions haven't been updated in a while, if our narratives don't reflect risks of 2023 and beyond, I would address that heading into your next exam. Again, if you're unsure, please reach out to myself or Frank. Here's an example, blue bars and this black line is total liquidity, green line is our policy limit. So you can see this is a severe scenario one of our credit unions built heading into their exam in September. They wanted to show the NCUA, we've changed our narrative and updated our most severe scenario. It shows them running out of liquidity. Here's extra credit. I would build a remediation or relief scenario. Let's link this up with the CFP. What are a couple actions I would actually take to buy myself some more time? Would I draw down wholesale funds and max out my borrowing capacity? Could I come up with a deposit special to slow down attrition? am I going to slow down lending? I mean, everything should be on the table, and dependent on the scenario and your balance sheet, that's going to be different. But if we link that up with the CFP and model that out, hand that to the examiners, that's going to go a long way. But even just from a strategic and comfort standpoint, within your own institution's walls, we've seen a lot of board members and executive teams really be surprised and gain some comfort in the amount of liquidity they have access to. And this last slide I'm going to share with you is another example of that, where this group was running off surge deposits over a short period of time. I would encourage you to do the same, surge or uninsured, and again, run that off quickly, first period of the model versus decaying that over time. This group ran a remediation scenario that showed we could stay within our wholesale funding limits, albeit we'd be at higher levels than we are today, but we would barely have to pare back our lending, and we could cover a lot more deposit runoff than we initially anticipated. So again, this gave this group some comfort that they're actually sitting on a little more liquidity than they anticipated. So to wrap things up, as Frank kind of talked about, we need to identify the right level of cash or our liquid asset cushion, but we really need to think about that in a holistic liquidity approach as well. But if we're going to do that, we absolutely need to have the right stress testing framework in place and make sure that our risk monitor is up to date. Because really, at the end of the day, we need to have these tools, but it's all about educating and defending our liquidity position to our key stakeholders, to the examiners, obviously, so our exams go smoothly, but more importantly, to give you flexibility to manage your funding bases and your balance sheets the way you want, which is ultimately, going to be best for earnings and best for your members. So with that, we're really appreciative of your time today. I'm going to hand it back to Omar for closing thoughts and see if there's any questions from the group.
Yeah, for everyone on the call, there's a Q&A section. Please drop your question there if you have any thought, or at some point after the call, if you want to reach out to me directly, happy to connect you with Jeff and Frank too. But, just in wrapping up what you and Frank, Jeff have put forward, I feel like the opportunity for some or most credit unions is educating the board. And I heard you say that, Frank, on multiple occasions, where the board is, they're a volunteer board, and most of them don't have a financial background, especially a background that you have, or maybe somebody that sits on a JP Morgan board might have. And so they're there looking at the executives for guidance in most cases. And so bringing experts like you into the board meetings, or educating the board, or even sharing this content with them will be impactful. A lot of the time I learn as I talk to credit unions, it comes down to three things. Policies, are your credit union policies getting in the way of your ability to have access to more liquidity? And then approach and practice. Defining what liquidity is seems to be a big hot topic for you, for me, and at the credit union level. And there's a cost of funds versus net income. Am I pulling the right levers, right, to ensure my cost of funds versus net income is adequate for my credit union? I want to make sure we answered a question that I think you've covered it, where what are the things I need to do to make sure I'm monitoring liquidity or keeping an eye on it. I feel like we've touched on that topic that came through. One other question that came by was, let's see here. We talk about marginal cost of funds. Is a credit union better off having a higher marginal cost of funds versus losing a core customer?
I guess it would depend on what the cost is. Is it truly a core customer? We find that exception pricing sometimes works well, but I guess it depends on what the true cost is. For example, if you have someone that comes in and says, I can get $575 in a 7-month CD down the street, you need to ask yourself, do you match that rate? Do you come up with a different offering? And if you pay, will you pay that person $575? If you don't pay them, they're going to leave. Then you have to ask yourself, is that truly a core customer? it's an art more than it is a science, but that's why it's important, as Jeff described, to make sure that we understand who our members are, what other relationships they have with us, before we necessarily go in and make pricing decisions. New product ideas can be introduced,
Yes.
different tiers, etc. So that's kind of a tough question to answer, but I can tell you right now, there are a number of institutions that we know of that went out and raised their money to retain some of their existing deposits. And what they found was they didn't raise a lot of new money. They just brought all their costs up. And the marginal cost was just much too expensive. We think if you lose a deposit to somebody else because of a CD special, whatever, keep a list of that and call them back later. Because if they left for rate, you can always get them back for rate. But, all things being equal, you'd rather have all your balance sheet fully funded with member deposits. But again, it depends how expensive it is at the margin to keep that customer.
If you were a credit union executive today, Frank, Jeff, what's, and you walk into the credit union and you're seeing a lot of those, hit the panic button scenarios happening where, it's a totally different environment. You called it in your first slide. We've never gone through something like this before. This is different. What's the first thing or the top three things you're directing your executive leadership to execute on?
Right now, I think because of the rapid change in interest rates and margins coming under pressure, inverted curve, where I started out the conversation is make sure we understand what is our liquidity position, how much access we have to liquidity, and that gives us the ability to then make decisions as to how do we make up for this compressed margin, this compressed ROA. For most of us, it's going to be a function of growth. We need to continue to grow. And how are we going to grow most effectively? And right now, the spreads are wide on securities. Loan spreads are wide historically. Why are mortgage rates 8% when the 10-year treasury is below 5%? That's a wide spread. A lot of us have exposure to that NEV soup test, which is forcing a lot of credit unions to now go short, extend funding, keep short assets. When in fact, you might be better off holding some of those long-term assets at 8% and funding them out 2 years at 5.25%, right? And maintaining that spread, right? So growth at the margin, whether it's wholesale or retail, but making sure that you have all the flexibility you can possibly have from a liquidity perspective, going through that basic surplus approach that we talked about, and then all the things that Jeff talked about to get the regulators comfortable. So revisit your policies, understand what your liquidity position is, and if something goes wrong, what's our contingency plan? But we think there's terrific opportunities to be growing at this juncture, despite the inverted yield curve.
Oh, I totally agree. It's a great opportunity for credit unions to maximize their share of wallet with their members today and maximize their TAM as you start to expand more products. A home equity loan doesn't need to be just a home equity loan. There's products within the home equity loan and how you present it to your members and get them excited about doing business with you, a car loan, a credit card, or mortgage loan, and so on. So Jeff, Frank, thank you so much. What a powerful webinar for us, our customers, and happy to share it with the entire credit union community. And this will be on, we'll put it on LinkedIn, we'll put it on YouTube and other social channels. But if anyone is interested to reach out to Jeff and Frank, come to me, our team, and I'm happy to connect you personally. I'll do a warm email introduction. I see somebody's already asking about that, so I'll make sure I do the introduction via warm intro. Otherwise, thank you all for joining. Happy to continue to have this discussion, and we'll have more webinars on this content. Follow Frank, Jeff, and I on LinkedIn, and see you all soon.
Happy Thanksgiving.
Thanks, everybody.